Hey guys, Simple Investor here. Today we're going to be taking a look at what the market's doing and how it quote unquote crashed today. We're also going to be taking a look at why that is and what I'm doing with my portfolio and how I'm managing it, some opportunities that might arise from this volatility, and what Warren Buffett did to raise some capital in this kind of volatile time. But if you haven't subscribed, be sure to subscribe and like this video as it really helps out the channel. So last week, the Federal Reserve kept interest rates steady at around 5.25%, 5 to 5.50%. They kept it because inflation has been sticky. Inflation has not really come down to the Fed's 2% target. This has caused stocks to kind of be a lot more volatile than what they typically are when interest rates are lower and borrowing is cheaper. That's usually better for the stock market, but the stock market has been reacting kind of in a volatile way with this. And they're in a kind of a precarious situation right now just because the unemployment rate is not improving. You can see here it's 35% fewer than expected. It's the highest since October of 2021. And the inflation rate is still close to 3% right now. So this is leading to something called stagflation. Stagflation is when inflation remains high and unemployment remains high, and you can't use the interest rate mechanism to basically make one or the other worse. You're going to have to pick which one is worse. So the Fed is in a really precarious situation just because either unemployment will increase because interest rates are going to stay high, or inflation will increase because the interest rate gets lowered. So the Fed is in a really precarious situation when it comes to that, and that's really affecting the stock market. Again, these numbers came out just last week when the Fed decided to keep the interest rate that way and these unemployment numbers. So the Fed is in a really precarious situation. And then leading up to today, when the stock market, I call it more of a correction. Warren Buffett on the weekend, when Berkshire's earnings came in, he dumped half of his Apple position and he took his cash position up to $270 billion. So Warren Buffett, he's kind of the messiah, if you will, of investing. Usually a lot of people follow what he's doing. He's raising capital. It's kind of scared the market a little bit. I mean, Apple too, if you look, it's not a bad time for him to sell Apple because they're trading at a traditionally high PE ratio. The last time it was this high, you're looking at December of 2020. So it's expensive. He even said at the Berkshire annual meeting back in May that they needed to raise some, they wanted to sell Apple for tax purposes. They were worried the capital gains was getting too high. Berkshire's typically never invested in companies that have appreciated this quickly. So that also plays into why he sold. But again, you're seeing today, they were talking about here on the Squawk Box, the Chicago Fed president was talking about how they're entertaining the idea of an emergency rate cut to address the situation right now. I doubt that'll happen. You're likely going to see a cut in September and maybe one in November, December. I would say two is likely on the table. And I mean, Powell's indicated that as well, that there's could be two. Before it was one, but now it's starting to really look like there's going to be two rate cuts by the end of the year. But realistically, what does that mean for your portfolio? Well, you might get scared seeing the S&P crash 3% today. That is not something you should be concerned of. If you're a long-term investor, these are golden opportunities where you really want to capitalize that. You can even see it's recovering after hours. It's recovered about 1%. So these are times where if you're a long-term investor, you really want to be taking advantage of these dips. I mean, I'd say more of a 10 to 20% reduction in the S&P, that would be a significant crash. This is just a minor correction. This is just a reaction to that data from last week, where it's just going to stay a little sticky in terms of inflation and unemployment. You're not seeing a reduction in unemployment. You're actually seeing an increase. It was below expectations, and then inflation is staying at that rate of around 3%, which is making it really hard for the Fed to deal with. And obviously, the market is not liking it. The market really wants cheaper access to capital. So that's kind of playing into it. But what does that mean for some individual positions? NVIDIA's looked really attractive today, in my opinion. I mean, they're still quite expensive, trading at a 58 PE ratio, but they've had just phenomenal growth over the past year. It's kind of hard not to look at them. And all of their clients are the Magnificent Seven companies like Meta, Apple, Amazon. A lot of those companies' capital expenditures actually go right to NVIDIA. So NVIDIA has a really good client base, and nobody else is manufacturing these GPUs for AI and large language model training. So NVIDIA really has a monopoly on the market. AMD's their only other competitor, but I believe it's like 90% of the market for those GPUs is controlled by NVIDIA, and then the other 10% is AMD and some other smaller manufacturers. So NVIDIA really has a control over the market in terms of that. But also switching over to kind of what the tech heavy NASDAQ is doing, it's down around 3% today. So actually a little bit lower than the S&P. And then you can see it's starting to recover a bit after hours. Again, this would be a phenomenal, it's very tech heavy. So it's a lot more volatile, but this would be a phenomenal pickup right now while it's correcting. This is not a time where you want to be. Um, I would say you could follow in Buffett's footsteps and raise capital, but honestly, if you're a long-term investor and you have a long-term thesis, these are the times where you really want to be buying and looking at investing into stocks. Raising capital is a good idea. Everybody should have an opportunity bucket. But this is the time when you want to be buying these dips, cost average into these dips, because long term your portfolio will thank you. And then shifting over to Tesla, I was thinking Tesla would dip a little bit more. I believe they got as low as the 180s today, but you can see they've recovered quite nicely today, up over 200 dollars a share. This is a position where I would really like to creep back into and increase my exposure into. Except I don't really like it over $200 just because a lot of future growth is already baked into the price. FSD hasn't materialized yet. Robotaxi hasn't materialized yet. That's also been pushed back to October. So, like again, there's a lot of future growth baked into this price here. If the market was really correcting, I was hoping that it would dip a lot more, but it hasn't. So it's something that one I'm definitely keeping my eye on. Nvidia is really intriguing today, though. That's one that I'm keeping my eye on, even though I'm not too bullish on them long term, just because I think that eventually those tech companies are going to start to look at manufacturing their own GPUs because realistically, AI isn't going anywhere anytime soon. Nvidia has extremely high margins. Let's see if we can see their margins here. But yeah, but you can see here. So yeah, their net profit margin is close to 53%, 54% actually, and it's growing at a nice rate year over year. So again, like I just don't see how it's sustainable for these tech companies to be paying those kind of margins, especially when the Fed starts to cut. They're going to be looking at maybe expanding their own operation endeavors into obtaining these GPUs on their own. Time will tell, but that's kind of my thesis on it. I don't really see how NVIDIA can really keep up this sustained growth that they've had, but time will tell. But I'd love to hear what you're doing with your portfolio in that comment section below. Like, subscribe, and we'll see you next time.